Hi, welcome to this video today, which is all about the best Forex technical indicators. What I'm going to do is I'm going to go through my favourite ones. But first of all, before I start with technical indicators, there's many people who say you should only use price action. So you should only use trend lines and candles. I don't agree with that view. In my 25 years of trading, I've always found that if I use some indicators that give me a deeper insight into the price action, and I think providing you don't overdo the amount of indicators you use, then I think they can really add a different dimension to your trading strategy. And the key really is, obviously there's no perfect technical indicator, but if you just combine a few with your trend lines, you'll be able to generate better trading signals, in my view, and increase your profits and reduce your risk. So one of my favourite technical indicators, I'm going to start with one of the simplest ones, which is moving averages. And moving averages just simply give you the average price over the period. And they're highly effective in Forex trading. And the reason they're so effective is because they can give you what is fair value within a trend. We all know that greed and fear will spike prices too far away from fair value, and a moving average is perfect for finding where fair value is in relation to in combination with trend lines. And I'll give you a very effective one, which is the 20-day moving average. In any strong trend, you just get your charts out and have a look. You'll see how often prices spike away from the 20-day moving average and then come back to it. So it gives you an opportunity to know when to get in on a big trend or even swing trade contrary. The next moving average I like is 40-day moving average, which I normally use as a stop. I use a trend line support or resistance near the 40-day moving average when I'm following trends, because if that gives way, a trend change could be on the way. And the other one is the 200-day moving average, which really gives you a great idea of the really long-term trends. Simple moving averages, they may be simple, but they are very, very effective. Price spikes never last, and prices always come back to a mean price or a fair value price. And I think that's why moving averages are so effective. I think anyone trading Forex needs to know the volatility of the market. If you've got low volatility and it switches to high volatility, then you've basically probably got a potential trend change on your hand. Now, standard of deviation of price is how far prices are moving away from an average price. And perhaps the most effective indicator, which actually uses a 20-day moving average as its center band, is the Bollinger Band. So you've got a center band, basically a 20-day moving average, and two outer bands that give you the volatility of price. When prices are very volatile, go to the outer bands. Prices could be extended, and that gives you a chance to lock in some profit or take a contrary trade. And it's very effective looking at any standard deviation tool when you're trading breakouts and ranges. You want low volatility switching to high volatility on the breakout. So I think you should always have a volatility indicator in your trading strategy. The next group of indicators is the momentum oscillators. And momentum oscillators basically give you the strength of the trend, okay? So they're basically trying to give you an indication of overbought or oversold. And there's many momentum oscillators around, and probably the most popular ones are the RSI and the MACD. And then you've got also the ADX and the stochastic. My personal favourite out of all those is the stochastic. But they all serve a similar purpose, which is to give you the strength of the trend. So what you can see is how far momentum is overbought or oversold. So let's say momentum is very overbought and you've got a potential breakout. You might want to be wary of that because there might not be enough velocity behind the move when it actually breaks the level. So it gives you, momentum oscillators give you a good insight to how overbought or oversold the market is. And they also give you the opportunity to do some contrary trading. So if prices are extremely bullish and overbought on a momentum indicator, and yeah, prices are stalling, that's very often a great chance to get in on a contrary trade. Now, with the indicators that I've just mentioned, none of them are new. I mean, they've all been around for decades, and they're still as effective today as they were when they came out. You've got a whole host of new indicators that come out. Many of them, in my view, are too complicated. These indicators are relatively simple. The logic behind them is simple to understand, and if you learn how to use them with trend lines, they can be very effective. So those indicators would be my favourites, and I think if you look at moving averages, get an idea of volatility on the price chart, and look at momentum, you'll be able to filter your trades a lot better than if you use just price action strategies. I know price action strategies are popular, but I just think that just a few indicators can give you a much deeper insight into the chart, increase your rewards, decrease your risks, and you're going to get the odds more in your favor if you learn some indicators and know how to use them correctly. No indicator, of course, works all of the time, and you have to use your judgment with indicators. But I've just found that over my history of trading now for 25 years that a few indicators in your trading strategy really does help you make bigger profits. I hope you enjoyed this short video. Take care and have a good day.